Welcome to episode 35 of Kontrarian Korner. I'm Ben Kellerin. Today we have a very special guest on for the second part of our podcast series on oil, and I'm definitely looking forward to chatting with him. And his name is Wilson. He runs the Substack HFI Research, and he's been all over Twitter and very vocal about some of the things going on in the oil market and the natural gas market. And I think it'll be very interesting conversation for part 2 of our series on oil. So Wilson, thanks for coming on.
Thank you, Ben. Thank you for having me. That was a great introduction, and I look forward to having this candid discussion with you.
Yeah. So we were talking a little bit before we started recording, and I think it'd be interesting to start with your general outlook for oil and gas in 2025, because there's been a lot of moving pieces. Everyone's been talking about OPEC spare capacity and the kind of oversupply or supply glut that people see heading into this year, but seems like that's not been the case, at least so far. So if you want to kind of take it from there, I think it'd be interesting to hear what you have to say about 2025.
Yeah, no, that's perfect. Coming into 2025, everyone had the expectation that oil market was going to be in a massive surplus. We've been very vocal about this with IEA's oil market outlook. They've pointed out that it's going to be a 1 million barrel per day surplus coming into 2025. And if you look at the inventory balances so far in January, we couldn't be further from the truth. January US oil inventories declined by 16 million barrels, and that's largely thanks to the colder than normal weather. Um, but aside from that, I think one of the key things, which we'll talk about a little bit more later, is that US oil production has vastly disappointed to the downside. And this delta is going to get increasingly large throughout this year. Now, from an oil price standpoint, I think there's still going to be headwinds. For example, China's demand is still weak, relatively speaking. So there's that factor. Trump's sanction enforcement is going to be questionable, whether or not it's going to take barrels off from Iran and Russia. And then I think in general, the OPEC spare capacity is still weighing on sentiment. Saudi Arabia does have real spare capacity left. You're looking at maybe 2.5 million barrels per day. With UAE, you have about another 800,000 barrels per day, and then Kuwait, another 250 to 300,000 barrels per day. So the Gulf Coast guys have a lot of spare capacity, while I think the others are more or less masking their production cut as really just natural base decline. Um, but aside, from a price standpoint, I do think this year will be largely range bound, and I think that's primarily because although you have global inventory still very low, the concerns from the market will continue to weigh on sentiment, which will keep financial flows at bay. But towards the end of the year, I do think prices will start inching higher towards that 80 to 85 range versus the 70 to 75 range we're going to start Q1 with. And I think the real bull case for anybody who's investing energy this year is really natural gas. I think although you're seeing this current pullback in that gas from bearish weather in February, there's a lot of LNG demand coming online the next 2 years, and we can talk about more about that later. But I think from an investing perspective, you probably want to be positioning natural gas equities towards the second half of the year, just in preparation for what's to come. Um, yeah, so and that's kind of my general outlook with oil. So oil is largely going to be range bound, moving structurally higher towards the end of the year as US oil production disappoints, and I think natural gas has the most upside towards the end of the year if production doesn't skyrocket, like we saw in 2022. I think producers learned, and this should, in theory, help a structural bull trend get started.
Interesting. So one of the things that I have kind of a question on, at least for natural gas, is like what are kind of the demand drivers for kind of the long term thesis? Because I know kind of the low IQ way to look at it is everyone's kind of extrapolating AI demand is going to be some huge driver for the growth in electricity demand and all these different things, and we're going to need natural gas and nuclear and go down the list, right? But as far as the kind of long-term thesis for natural gas, like people have talked about LNG and some other things, what are kind of the drivers there over a say 3 to 5 year period for your kind of structural bullish view on natural gas?
Oh no, that's a great question, Ben, on the structural demand drivers. First, I think I think natural gas equities rallied, especially the US ones, rallied in part because of the AI frenzy. When Trump won the presidency in November, um, a lot of natural gas equities skyrocketed because they thought LNG would be more free flowing, the permitting process would get easier, there would be more data centers surrounding on AI powered by natural gas, and there's going to be less renewables. So, natural gas equities actually really performed well after Trump won. And I think that's largely driven by that whole AI, enthusiasm. But I think this chart best illustrates where reality is. So this chart is from S&P, and if you look at the total supply growth, it's about 13.5 BCF per day from now to 2029. That's most of that is going to come from the Permian and Haynesville. And if you look at the demand side, total consumption is going to increase by 14.2, with export demand being 15.2 of that. But you see, here's the issue I have with their forecast is you can see power burn demand actually decreases by 4.2 BCF per day. Um, and the reason why they have power burn demand decreasing is because they're saying that coal power plant retirement is going to slow as natural gas prices increase because of the LNG increase. And on top of that, you have renewable penetration, taking more market share. So if you look at that modeling, the problem is that they're not even assuming a power burn demand increase from AI, which is really crazy if you think about it. Now, EQT, which is the largest natural gas producer in the US, has projected 7 to 10 BCF per day of demand increase from AI. Now, I don't think that's realistic either. You're probably going to be somewhere in between that. And so, even if you assume renewable penetration and slower coal, power plant retirement, you're maybe looking at like +2, +3 BCF per day. Now, if you assume that power burn demand just doesn't decrease, then you have all of a sudden a 5 BCF per day gap between consumption and supply growth. And so that delta is going to have to be made up via either lower LNG exports from higher prices or higher supplies. And so the real demand driver is really just going to be LNG. Um, and less power burn demand loss. And so the bull case all of a sudden for natural gas doesn't really have to rely on um, AI going crazy. You just have to assume that power burn demand doesn't decrease, which I think is a very sensible valuation method. And now there's concerns about LNG market being oversupplied, and I think that's a valid concern. But the problem that people are not factoring in is that US is really going to be the price setter going forward for global LNG markets. A lot of LNG contracts are still based on Brent, and they're long-term take or pay agreements. So any spot demand increases in the LNG market should start to sway prices from the Brent linked type contracts. So I think the US is going to become the price setter for global LNG prices, which should benefit importers. And that should allow the US to export as much as possible. There will be a time period when the US market cannot handle the amount of export increase that's coming. And the reason why that is because we have not increased our working capacity in natural gas storage since basically the start of the shale revolution. And so at 4 TCF, of gas storage, LNG is going to be a huge portion of the total demand. And that in itself will create a lot of volatility in the natural gas market, especially if you have bullish weather like we saw in January. So I think going forward, there's going to just be a lot more volatility in the natural gas market, coupled with, you know, potentially limited supplies. And I say potentially because Permian does have a lot of gas, so it's really just a matter of how fast can they increase their, pipeline capacity. But I am fairly bullish on nat gas going forward. I think the LNG increase coupled with limited storage capacity, coupled with this idea that power burn demand is going to decrease. I think those are really the key drivers for natural gas prices going forward.
Yeah, interesting. You mentioned the Permian there a little bit, and one of the things I think has been interesting to watch over time is the Permian continuing to get gassier and gassier. And you've been pretty vocal about that. You don't think the Permian is going to be able to surprise on the upside as far as production of oil. So I think
Yeah.
that'd be an interesting place to take it next, as far as your thoughts on the Permian Basin and production, and maybe some of the EIA, IEA numbers as far as what you're seeing versus what is being reported.
Excellent. Let's go to the first chart in the slide. So that's a great question, Ben. If you look at at HFIR, we have this production composite index, and basically what we do is we take the weekly U.S. oil production, but instead of taking it at face value, we adjust it with the adjustment factor. So in the weekly EIA report, there's a figure at the very bottom called adjustment. And previously it was called unaccounted for crude oil. And what that does is it basically balances the equation. And so in the weekly EIA survey that it publishes, it asks producers what the production is and storage and all these other various factors. But because it's a hard data to get on a weekly basis, EIA actually just publishes an estimate for the production. So the production side is unknown, but what's known is the storage. And so by knowing what the storage figure is, you can triangulate, going backwards and figure out what the production is. And we use real exports and real imports to figure out what the real adjustment is. So not only is the adjustment have to get modified, you have to adjust the adjustment. So long story short, using that method, you can figure out what real-time US oil production is. And so if you see in that chart, that green line basically reflects what real US oil production is. And so that figure has been flat since the end of 2022. And EIA has been playing games with US oil production figures since 2024. And that caused a lot of the production figures to get overstated. And so on the surface, it looks like US oil production is surprising to the upside when it's really not. And I think that caveat really made it so that the consensus thinks that US oil production is going to keep growing when really it's been basically flattish for the last 2 years. And so our methodology shows that, and now the real-time data is starting to show that. And US oil production is starting to disappoint quite strongly um, versus consensus expectations. Let's go down to the chart below this. So as you can see in the EIA 914, which is the official US oil production data, it you have to factor in the adjustment figure, which is again, it's the plug. But that plug basically tells you whether or not it's outperforming or underperforming. And so when the adjustment is positive, it means that the US oil production is understated. And when the adjustment is negative, it's saying that oil production is overstated. And as you can see, using EIA's own data, since the end of December, this production figure has been largely flat. Now, again, there's a lot of different data stuff that they introduced in 2023, like transfers to crude oil supply, which basically made it almost impossible for generalists to follow. But if you take this methodology and you look at it, you can see that US oil production has basically peaked since we reached the top level in 2022. And this has been a trend that we've been pounding the table on for the last year and a half, and it's really not going to gain any tractions until this year. And the reason why it's going to gain a lot of traction this year is because if you look at the chart below this, it's because all of a sudden you're going to start seeing associated gas production, which is the yellow line, start materially move higher as the crude side disappoint. And so this delta is precisely what we've been pointing at, is that Permian is getting gassier, it has higher NGL content, and it's having a lower crude production mix. And so the combination of the two suggests that not only is the Permian going to be peaking soon, um, there's really not much growth left. And so that's where we're getting our insights. So we're basically validating our what we think is happening with our weekly data, and then for using the weekly data coupled with the natural gas production data, you can figure out, okay, where exactly is US oil production headed. And using this two method, you can kind of forecast what production will finish by the end of the year. Yeah, so in essence with US oil production disappointing, I think the delta is going to grow increasingly large. For Q1, US oil production was projected to be about 13.45 million barrels per day, and our real-time data is saying 13. And by Q2, consensus has US oil production at 13.65 million barrels per day, and we think it's going to be closer to 13.1. So you're going to have a quite large delta going into the middle of the year, and I think that's going to show in both investor sentiment and the data. Like oil inventories are not going to build, which is going to make people start questioning what's going on with US oil data. And it's largely because US oil production is disappointing to the downside. So I think the reality will hit fairly soon, and the data should validate what we're saying.
Interesting. So it seems like the consensus, at least from my understanding and from what I've seen as well, is basically that Permian's going to continue to grow. It's not maybe growing as fast as it was, but there's still growth there. Whereas you're saying it's going to be kind of starting to flatten off and eventually start to decline in production, or you think it stays kind of flat around 13 level for a while?
I think US oil production has the ability, especially if oil prices cooperate, to bump up to maybe 13 and a half to 13.7. So you have another maybe 600 to 700,000 barrels per day of growth left. But that's about it. And now, can you stay at 13.6, 13.7? Absolutely, at the right oil price. I think 85, 95 WTI could definitely support that level for years to come. But now the treadmill decline nature of shale production, it's you have very good wells in the first year, but they decline parabolically at the end of year one, usually 70%. um, it starts to weigh on how much production you can hold. That's another reason why you haven't really seen U.S. oil production surpass the 2019 peak in 2022. It's just because of that decline nature. Um, Now, I know there are some Permian bears that say oil production is going to drop materially. I'm not of that view. I think Permian can sustain U.S. oil production in that 13 to 13.5 million barrel per day range for at least a decade. I don't see a scenario where production meaningfully drops off. I think producers there, like Diamondback, are getting more and more efficient in terms of drilling, and they are just going to keep finding ways to get more efficient. Um, but in terms of growth, I think this is about it. You're already at the latter stages of a growth type play, and it's U.S. shale. Basically, the Permian bailed out the world from a structural oil supply deficit when it started in 2016. So, without the Permian, the world would already be in a lot of trouble. So now with the Permian peaking, I think it's you're gonna need some other areas to really support the supply side, or you're gonna have kind of this structural supply deficit incoming. Um, by the end of this decade.
Interesting. So I know there are some people that don't think there's like a Permian production rollover coming. Some people that think it's geological, right? That it's kind of bound to happen eventually. I've seen people posting that production per foot is down and the wells are getting more efficient, but they're also drilling longer laterals and all those things.
Yeah.
But as far as the kind of long term view from your end, do you think that it is kind of a question of geology and eventually there's going to be basically it's inevitable, or what do you kind of think there?
Yeah, I think you look at the type of well results that these guys drilled in 2020 and 2021. I mean, they were spectacular. Um, you talk about just material efficiency gains, and suddenly in 2022, when oil prices went up, you started to see some deterioration in the well productivities. And so I think a combination of just starting to run out of the really good wells, and also from an apples to apples perspective, you're comparing like semi decent wells to like extremely good wells from 2020 and 2021. They needed to drill those to survive, so it's not like they wanted to, they had any choices. I mean, everybody basically drilled their tier one wells in those tough years to survive the crazy oil price downturn. And so now you're kind of seeing operators really understand the reservoir better. You're seeing the M&A activity take over. And so, guys like Exxon, which is still expecting relatively large growth, you'll notice that they didn't specify how much percent of the growth is going to be from liquids as opposed to net gas. Um, and I think as guys like Exxon drill longer and longer laterals, they'll notice that they're getting more efficient with their cost and they're getting better well results. But on a foot basis, like you said, the productivity is going to start to decrease. And then especially I think from the liquids weighting side, it's going to start to decrease as well. So I'm expecting some pretty decent sized revisions in this reserve reporting in the next few weeks when Permian producers report. I think guys like Diamondback are still going to report excellent results. They're the top of the top in the Permian side, and I think some of the less quality guys will start to report higher gas weighting. And I think that's another reason why guys like Chevron is expecting a plateau at 1 million barrels per day versus their previously 1.2. And I think that's just from reservoir management. They need to manage the asset for the long term. You want to maximize the net present value of the cash flows, and so you need to space out the wells. You need to make sure you're not drilling too fast, because the faster you drill, the faster your decline rate. So there's going to be a lot more asset management side. That's why I don't think the Permian is going to roll over anytime soon. I think the Permian is going to be here to stay for a very long time, and operators are going to get better at what they do. But that doesn't mean that U.S. oil production is going to go up as a whole. I think you're probably at the peak or close to the peak.
Interesting. So the tier one stuff is gone, but you mentioned some of the stuff as far as consolidation. Do you think that we're going to continue to see smaller players get gobbled up by larger names like Chevron, Exxon, maybe Diamondback?
I think there's maybe one more private producer that gets bought out. But a lot of the consolidation stuff is basically over. Now it's important to remember it's not that the tier one stuff is gone. It's that the tier one inventories are in the big players' hands. So you're talking like Occidental and
Hmm.
like Diamondback and Permian Resources, like they have tier one stuff. It's just how do you manage that inventory, right? Like you're not gonna, like at 70 Ti, you're not gonna drill all your tier one. Like you want to wait for high oil prices. You want to be able to manage the reservoir. You want to be able to manage your cash flow, maximize the net present value for your shareholders. So you don't want to just drill all the good stuff now. You want to slowly capitalize on those assets. And so you're seeing a lot more like smarter management style with the reservoir. And I think from an M&A perspective, you're probably towards the tail end of the M&A. I don't see that much more consolidation. I think this is probably it.
Interesting. So as far as the I think one of the things you're saying there too that's interesting with the tier one stuff is it basically right with the decline rates being what they are for shale, you don't want to go and basically waste that on $70 a barrel versus say,
Correct.
hey, like we're at 85 in
Correct.
six months or a year or whatever it is. So um as far as some of the political changes that have happened with Trump coming into office for a second term, I'd be curious to hear if you have any thoughts on how that might change things for the sector or for what else is going on with oil and natural gas. Because I know Trump is one of his favorite pastimes is tweeting about oil prices being too high and all these different things. So he's bound to throw out a tape bomb here or there. But I'd be curious to hear your thoughts on the political side, on sanctions or tariffs or anything else going on that kind of has caught your attention.
Yeah, I think Trump is a wild card. We've lived through the 2016 to 2020 era, which was not bullish for oil and natural gas. But I think that's largely because of the Permian Revolution that started in 2016.
Mm,
U.S. oil production really surprised to the upside in 2018. I mean, to give you perspective, relative to expectation, U.S. oil production surprised the upside by 1 million barrel per day in 2018. So you can go back and you can study history and say, oh, Trump was bearish because he did the sanctions on Iran and then he rug pulled the sanctions, but really it's not. It's because U.S. oil production meaningfully surprised the upside that really resulted in that sell off in Q4 2018. So um, I think from a big macro perspective, Trump's tariffs are going to be inflationary in nature. You're going to increase the cost for US shale producers from raw material tariffs. And simultaneously, you're talking about drill, baby, drill. I just don't see how that is going to happen, especially with the way, as I was saying, is a lot of these producers are starting to try to maximize the cash flow from these assets going forward. Um, Now, what is going to happen is I think on the surface level, Trump looks like he's bearish oil, right? Because he tweets about how he wants lower oil prices, but I don't think it's actually going to have that much of an impact on the fundamentals of the market. And the reason why is because OPEC plus, Saudi Arabia in particular, has learned from their 2018 mistake. They learned that okay, don't prematurely increase production just because Trump has promised sanctions on Iran. And so I think for OPEC plus, they're going to remain pretty patient with regards to increasing production. And the question really just comes down to sanction enforcement. I have no idea whether or not he's going to be successful in sanctioning Iran or Russia. Um, China is the main buyer for Iran and Russia. India is a big buyer for Russia. Um, I just don't see how any type of sanction enforcement would actually force them to have lower crude flows. I don't know. Um, I know Dr. Al-Haji has talked about this and he doesn't believe that Iranian sanctions will be effective. I'm sort of in the same camp with them. I do think there's going to be some loss in barrels just due to logistical delays, but other than that, I just don't see how Iran's going to lose that much production. But what I do think is going to be very bullish for oil is the SPR refilling. Um, you're talking about 370 million barrels of oil that needs to be bought back into the strategic reserves. And so, if you space that out over 2 or even 3 years, you're talking about 250 to 400,000 barrel per day increase in demand, and that's a 25% to 40% bump in annual demand growth that is not expected in the market today. I think that's going to be a very nice tailwind. Now, is he actually going to follow through with SPR refilling? I have no idea, but he's already said that he wants to do that. So, you know, it- it's a potentially a very bullish event if that happens. But one thing I know that we learned from the 2016 to 2020 era is that don't look at what he says, like look at what he does. So I would just tell readers that it's going to be a lot of noise versus substance. And so when you see substance, then reassess. And I think that's how the market is going to play as well. I think over time, they're going to start paying less attention to the tweets and more attention to the substance,
Yeah,
because there's just going to be too much noise. Um, yeah, so that's kind of my take on Trump.
interesting. As far as Canadian tariffs, as for oil specifically, I personally have a hard time believing that that's going to be a big issue as far as what they actually put in place because of how much Canadian oil basically feeds into U.S. refineries. But um, do you have a view on the likelihood of actual tariffs being put on uh, oil coming down across the border from Canada?
I was just looking at, it's a great question. I was just looking at the betting market on this, and they're expecting like 81% probability that Trump enforces tariffs on Canada. So, the betting market obviously thinks that it's going to happen with high degree of certainty. But from a logical standpoint, you're talking about 4.1 million barrels per day of crude imports, and it's all the stuff that the U.S. refineries need. It's the heavy stuff. And there was a good article I wrote about, why the Canadian. I don't think the tariffs are really going to be put in place for a long time, and that's because U.S. shale production is getting lighter, and so U.S. refineries typically need about API gravity crude of 31 to 33, and U.S. shale produces predominantly in the 45 range. So you need a lot of API crude gravity around 20s to offset the light sweet crude, and so I have a hard time seeing how it even makes sense. Now, from a negotiation tactic standpoint, it makes a lot of sense. You can threaten tariffs. You can say we're going to impose it on your most important export, which is crude. And in exchange, we want these, this, and that. I can see how that works. And but Canada has other measures that they can enact to offset some of these tariff threats. It's one of them is Alberta can manage production. You saw that at the end of 2018 when WCS relative to WTI blew out into the 50s. And so Alberta can go in and mandate all producers to cut production to offset maybe some of that tariff threat. I have no idea if that's actually going to materialize, but that is a possibility. And so you can potentially even squeeze the heavy crude side, which would obviously be inflationary for the US, and Trump hates high oil prices and high gasoline prices. So I just don't see how that's beneficial for either side to do that. So I do think even if it is imposed, I think it will be short lived. It's a key import, and it's going to be very hard to replace 4 million barrels per day of heavy crude. Um,
Yeah. I mean, I could see tariffs on Canada, but then there's like a carve out for oil in there. And maybe a couple other things that are very important, but I do have a hard time seeing like, oh yeah, we're gonna slap a huge tariff on all the stuff we need that needs to go into refineries. But um, as far as some of the stuff you're saying about political changes, do you think there's any chance that Trump is able to get things moving for California energy production in general, or do you think that's basically a lost cause for the time being because of who's in power in the state government and the regulatory capture they kind of have?
I don't necessarily think it's going to be Trump that forces change. I actually think it's going to be the voters. I mean, I think with the wildfire that happened, which is just a total tragic event, I don't see how people are still going to find Governor Newsom. Like I just don't see how people can still support him. I mean, it's just been a total mess. So I think it's more of a political shift. I mean, I don't know if that's even possible in the state of California, but um, I think it's just bound to happen. Woke policies are just not going to be. It's just not sustainable. Europe is next. I mean, we saw that with Trump beating Harris this time around. I mean, it was a blowout. betting market thought it was going to be 50-50. I mean, that was one of the most mispriced events in 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 history, you know. And so I think, yeah, I think California is just a ticking time bomb waiting to happen. I think there's going to be a major political regime shift, hopefully, you know. And with that, and hopefully the regulatory environment gets better as well. That's just my non-specialist view on the political landscape in California.
Yeah. No, I think it is interesting because he was basically looking like the front runner to run in 2028 for the Democrats, and now he's kind of damaged goods. So we'll kind of see if that changes. But I think you're right that there's maybe some political wind shifting there that could be interesting to watch. Um, Before we kind of shift over to the equity side and what you're interested there, are there any charts or anything that you want to hit on before we kind of head over to talk about some of the sectors in equity land that you find interesting for
No,
oil and gas?
this is perfect segment.
All right. One of the things that I find interesting is some of the stuff going on in Canadian oil and gas, because you kind of have the long life production assets. You've got some of the operators up there that I find pretty interesting, but I know that it's been a minefield over the last couple of years. So maybe if you want to start with some of the interesting picks in Canadian oil and gas and some of the oil sands names, I think that'd be a good way to start.
Yeah, so two of my favorite names is one of them is Strathcona Resources. It's backed by the Waterous Fund. That name is particularly interesting because they have a lot of organic growth ways ahead. And it's not the cheapest name. It's currently trading at a free cash flow yield of about 9.97%. Um, and it's interesting because it has very low float right now. Most of it is owned by Waterous Funds investors, and so institutional investors have a hard time getting to the name. But with the growth trajectory coming on and the reserve report valuation, it's worth about 50-ish dollars in net asset value from a reserve standpoint, PV10. The stock is trading at 28, so you have quite a bit of upside from the reserve perspective. And as the investor base sells with and freeing up liquidity, I think you'll get more institutional traction. um it's a $6 billion market cap company. So I mean, I think there will be quite a big following down the road once the liquidity frees up. Uh, Aside from Strathcona, my favorite has always been Meg, and I think Meg is just one of those names where it's brain dead. You just buy it, wait for it to make money, buy back shares, and just wait for somebody to buy it out one day. I think that's kind of the investment thesis in Meg. There was a report I think I wrote back in November or October. I said just don't do anything, just buy Meg. And I think it just because they're going to cannibalize their shares. Um, and at today's oil price at 70 TI, Meg's free cash flow yield is about 9.66%. And so the longer the shares stay cheap, the more shares they buy back. And because of the long reserve life nature of the assets, you're able to buy back shares. And I think this is a good topic I want to talk about as well, is the share buyback nature of energy companies. Now, when you look at an energy company, most companies cannot buy back shares. Like, and I'm going to use Baytex as an example. Sorry to pick on Baytex, but when you look at a name like Baytex and they have PDP reserve per share below the stock price, you're buying an asset that's not really proven. I mean that's basically what proved reserve value is, PDP, producing proved reserves. And so you typically want companies with a very long reserve life, because when you buy back shares, you're basically buying the very asset that you have that's producing. And so the longer the reserve life, the safer it is in terms of the decline rate and all these other things, execution risk factors and the various sorts. But when you have something like Baytex and Eagle Ford and production parabolically declines and you have to constantly drill to keep production flat. Like it's harder to buy back shares. In those instances, instead, the company should be allocating capital to improving the quality of the reserves. So you want to keep expanding the inventory. You want to make sure you're de-risking inventory. You're building a high, base of nice quality wells where you can continuously drill for many years to come. And in the instance of something like Meg, where you have this long run life, you could just keep buying back shares because that assets are proven. The execution side is de-risked because of its previous projects, and so it really has no quote unquote downside. It's just oil price becomes the kind of the unknown variable, and it's the same with Athabasca. Meg and Athabasca are basically in the same boat. Athabasca has more growth because of its Duvernay position. But aside from that, those two names are going to offer you high quality reserves for a very good price, and eventually both names should get bought out. And it's just consolidation is going to continue in the Canadian energy space. There are too many small producers, and I think it's an inevitable trend going forward.
Yeah, one of the things that I had a buddy who was talking to me about some of the oil sands names, and I think he called Baytex Bagtex. But if I remember right, that one was a serial share issuer, and so their share count would just explode. And basically, it's been a one way street as far as share count. While you have, like you said, some of the names that have been buying back stock for at least a couple of years now. So
Yeah,
um, as far as the big names, I know that CNQ is kind of the high quality. Everyone talks about that as being the best of the best and one of the biggest.
yeah,
Um,
blue chip.
the other one that I've talked to a couple people on that they're pretty bullish on is Suncor, which is one of the other big names. Do you
Yeah.
have any thoughts on some of the big companies in Canadian oil sands?
Yeah, Suncor is phenomenal. Rich Kruger, who was brought in by Elliott Management, is just executing phenomenally. Suncor's always had arguably one of the best downstream operations in the world. Their refinery just knocks it out of the park. They have ability to price WCS as well because they're a large storage holder. And so Suncor's business model has always been very bulletproof. Um, when I went through the 2018 debacle with WCS and WTI spreads blowing out, I just wish I owned Suncor. Arguably, they have so much pricing power. They made so much money trading that year. It was pretty ridiculous. But they've always suffered from upstream. They've always had issues executing on the production side. They've always had issues making sure that their safety and execution was on par with peers. They've always messed that up, but their asset base was never bad. And so I think when Elliott went activist on them, it really changed the narrative on the business. And Suncor has actually been relatively flat, even though Kruger has done such a phenomenal job in turning around the business. They've outperformed the last five quarterly guidances, I believe, four. And they're just executing spectacularly well. They hit their debt target well before the street expected, and I think it's just a matter of time until I think Suncor is probably a double from here, with 75 to 80 WTI. So I'm fairly bullish on Suncor. It's actually our second largest holding in the HFI portfolio. Another name is Cenovus, which is getting a lot of flack for their downstream operation mishap. You see, it's funny because Cenovus has a great upstream operation. They're one of the best at producing, but they are not very good at running a refinery, and that's largely because they bought Husky, which insulated them from WCS WTI spread differential risk. But then now they have underperforming refineries, which they're throwing billions and billions of dollars into. And quite frankly, it's going to be cash burning for few more quarters or maybe even a few more years. It's hard to turn around a refinery. It's a lot of capital has to be put back into place to make sure that the operation runs smoothly. And I think Synovus will eventually turn it around. It's just we don't know when. Um, and as for CNQ, I think if you just want a low risk name and not worry about oil prices and stuff like that, you can just buy CNQ. I mean, it still trades at 9% free cash flow yield, so it's not like it's overly expensive, and you get good oil beta. They have they are they have some of the best land in Canada, and they're never going to sell. And so anytime you talk to any, you know, up and coming CEO looking to buy land, they always say CNRL has it, CNRL has it, and they will never sell. And that's their competitive advantage. They just have so much reserves that they can just do whatever they want at any time they want, and they will have, high quality inventory for the next 20, 30 years, and they're never going to run issue with that. And I think that's why it's such a high quality name. So that's kind of my broader view on the bigger names. I think I'm most bullish on Suncor, and CNQ is we don't own CNQ, but if somebody wants a very low risk way of playing the oil market, that's what I would recommend. I mean, can't really go wrong with CNQ, but Suncor is definitely one that I'm looking at favorably.
Yeah, interesting. I know some people, one of my buddies I was talking to, he looks at kind of the oil sands names and Canadian names in general as like the torquiest way to play an oil bull market. But do you have any names in the Permian Basin that you find interesting, kind of at the current juncture?
Well, Diamondback, I think is with their acquisition of Endeavor, I think they are so well positioned for the years to come. I think it's just their team is spectacular. I think that I have a hard time betting against Diamondback. I think they're the top, of the top. And in fact, if you look at the reserve report from last year, their newest one is not out yet, but they're the only ones that increased their crude mix on the reserves relative to others. And so they're
Hmm.
not really suffering from the same NGL surge mix that we're seeing from other producers. Diamondback is one of the few that's going to keep executing. And if you look at the synergies from the acquisition they made with Endeavor, I mean, they're going to be well situated for years to come. So if you want a Permian name and not worry about any downside, I just go with Diamondback. I just don't see how that name goes wrong. Some of the other Permian names I'm not too familiar with. John at Ideas from HFI Research is more of the ideas guy, so he kind of goes deeper, Permian resources and others. But I just go with Diamondback. Now, obviously, Warren Buffett's favorite, Occidental. I'm not very fond of their acquisition with Crown Rock. Uh, I don't think it was a good acquisition, and a lot of the guys I've spoken to also don't think very highly of the acquisition. So from an execution standpoint, I would Occidental might have more upside, but I would just stick with Diamondback. I think those guys are the S class when it comes to operators. So
Interesting. Is
yeah.
there anything outside of North America that's kind of caught your eye as far as stuff that might be a little more speculative, have some
Yeah,
hair on it, but stuff that you find attractive enough to dig into a little bit?
yeah, there's we made it's an interesting name. It's called New Stratus Energy. We made our write up public on our page. And basically it's an interesting name because it comes down to the settlement with the Ecuador government. In late 2022, they had their permit on one of the blocks taken away, and so they sued. And there's been a bunch of news reports saying that they're going to reach an agreement with the Ecuador government with Sinopec as a partner. And we don't know what the details of the deal is going to be, but apparently it's supposed to be expected by the end of January or the beginning of February, or whatever it is. And so when that if they reach a settlement, we'll have to see what that looks like. And I think that's kind of a very interesting name because it's currently at a market cap of about 60 million Canadian. And the block that they're thinking about getting is called Campo Sasha, and it's 77,000 barrels per day of oil production. So it's quite large relative to their market cap. So I mean, you're looking at a possible 2 to 3 bagger if this thing actually is what it is. Um,
Are there any debt issues there or any
oh, they
dilution in
don't.
there?
Yeah, they have no debt. They have a little bit of cash. They have operations in Mexico, and they had operations in Venezuela, and then now they're getting out of it. I mean, it's a very speculative name with no real producing assets. But the good news is that they have no debt, and so you can afford to wait, so to speak. And so for s- I know some people have talked about it on Twitter, and you can kind of type in the ticker name, and you can kind of see the back and forth. But um, it's highly speculative. We have like a 2% position in that name, and we're just it's more of a lottery ticket kind of thing. And if it works out, great, and kind of just stick with it and see where it goes. But uh, yeah, other than that, we don't really have any other meaningful positioning at any other energy stocks. So,
Interesting.
yeah.
As far as any last thoughts that we maybe glossed over or kind of skipped as far as big picture oil ideas or natural gas things, I wanted to kind of open it up a little bit to see if you had anything you wanted to hit on before we start to wrap up.
Yeah, I just think I think I think for your listeners, I think the natural gas market is definitely one you want to pay attention to. I think it's rather fascinating where we're headed. Um, because of the dynamic that I'm seeing, with the LNG increase and limited working storage capacity and potentially slower production growth um, from the nat gas side. I think there's going to be this temporary disconnect towards the end of the year. And so you have a lot of the Canadian natural gas names still trading at a severe discount relative to the US peers. Like you have Tourmaline, which is one of the highest quality names, is not exactly at a very high valuation relative to something like EQT or like a Pado. Pado is, they have a dividend yield of like 10%, and it's one of the best natural gas producers with their recent Repsol acquisition. It's a very attractive name relative to the risk, and with the potential upside in that gas, I think a lot of these names are undervalued. And with a name like Pato, you can actually that the management team is going to hedge. So if natural gas prices start to spike, they're going to start hedging, and so a lot of those prices are going to be locked in for years to come. And that's what happens when you have a great operator like Pato, um, running the show. And I think something like a Pato, like a Spartan Delta, which is another name that has a lot of exposure to nat gas, but also oil. A lot of these names are cheap. I think owning a portion of your portfolio in some Canadian energy, oil and gas names make a lot of sense, especially with what I'm seeing on the gas side going forward. So that's the last message I will leave with your listeners. But thank you for having me today. I really appreciate this back and forth.
Yeah, I appreciate you taking the time to come on. If any of my listeners want to find your work or social media, where can they look to do that?
So HFIR.com is they can come and become a free subscriber, and we usually publish quite a bit of content on the free side as well. So hopefully we can bring them some insights that can help them make money.
Yeah. And before I let you go, I do have to ask my traditional closing question, which is what book should I add to my reading list? Can be history, finance, anything you think would be interesting.
Oh, I recently read The Courage to Be Disliked. It was recommended by Mark Andreessen. I strongly recommend that book.
Okay.
It was very eye-opening for me. I think and the way they write it is quite fascinating. It's a dialogue type writing format between a student and the master, and so I thought that was quite interesting. And no, I highly recommend that. And my favorite finance book is More Money Than God.
Okay.
Um,
I'll have
I've
to
read that God knows how many times, but that's one of my favorite books of all time. It's just great storytelling on the hedge fund history, and it kind of goes into detail about each hedge fund manager like Soros and Druckenmiller and Julian Robertson, all those characters. And so you kind of get to see like what they had to live through, and I think that's a nice way of learning the style, right? So
yeah, I'll have to check both those out. Both sound pretty interesting for different reasons. But I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.